While overnight it may have looked like we were going to get lower interest rates today, here came the Fed minutes along with the 10-year auction, and it pushed us right back up to where we started. We're in a sideways holding pattern, y'all. What's going on? My name is Kevin Weedmark, a.k.a. The Mortgage Mouth, coming to you with another episode of the Daily Dose. Make sure you hit that subscription button so you never miss a beat. And while the market is starving for significant data, the Fed minutes, the takeaway was today and why it moved interest rates up as well as that 10-year auction was, number one, the 10-year auction came in a little bit light. And what that means is further down the road, should that continue, and it looks like if the government shutdown continues, right, it would mean in the long term that the Treasury would have to do issuance, which is inflationary. So that's bad. So that's why you saw interest rates in the 10-year Treasury recover from the lows of today, as well as we had the Fed minutes released today. And although it's a thing of the past, it still gave insight to the fact that there were a couple members that believe that there's no rate cut should have occurred, and that only half of the members still see 2 rate cuts this year. And lastly, inflation. Big concerns about inflation. Very worried that that is something that's going to remain pesky, which brings me back to what I said. Hey, is 3% the new norm? And if it is, and I don't think that the Fed members have come to grasp that that's going to be the new norm because they have their eye on the prize of 2%, and I don't think they're going to get us there. But what does that mean for then long-term interest rates? What does that mean for the Fed funds rate? What is the Fed's reaction going to be with the new normalcy of 3% inflation? All right, y'all. Have a good evening. Be coming to you tomorrow with another episode of the Daily Dose. We do have Fed Chairman Powell speaking, so that'll be something to note. That has obviously the potential to move markets. I don't think drastically, but I think it can absolutely move that yield spread into the lower end of our current ceiling and bottom, which is about 4.09, and it seems to be about 4.2 somewhere in there. We just seem to be hovering in this range until we get the shutdown behind us and we get that data that we're seeking. All right, be coming to you tomorrow. Have a good one. Hit that subscription button.